What's behind today's slide in stocks? For that conversation, joining us now is Andrew Slimmon, Morgan Stanley Investment Management Managing Director and Senior Portfolio Manager. Thank you so much for joining us, Andrew. Let me just put it to you there. How much of today's market action, especially in the U.S. markets, as Anne-Marie was just pointing out, is coming from that geopolitical risk?
Oh, I think that's a big part of it, and it's uncertainty about the Fed. The Fed pivots. I mean, these are all kind of ingredients that do cause kind of 10 to 15% corrections, and it's been long due. We haven't had that since the early fall of 2020. So, Mark, accept this and realize that this is all part of investing in equities. But these are, geopolitics always causes anxiety in markets.
So what do I do with that? You've got a conflagration of factors, Andrew. Good morning, it's Guy. We've got earnings. You've got GE down today. You've got Raytheon under pressure. You've got the Fed coming up. We don't know how hawkish the Fed is going to be tomorrow. Maybe it's dovish. Maybe we get a dovish surprise. We just don't know. And then you've got the geopolitical story. Bring that together. What do I do with my portfolio in this kind of environment?
Yeah, that's a loaded question, guys. So look, my view, is everyone wants a pullback to invest into. I hear that all the time. But then when the pullbacks happen, they're for scary reasons, like geopolitics issues or the Fed pivoting. So I think you need to develop a framework with which to be unemotional and say, okay, pullbacks here, I'm investing. Now, are we at that level? 10% pullbacks are not that unusual. 15% pullbacks are not that unusual. 20% pullbacks are unusual. I think we're getting in a range where you should put money to work. We're past the 10% pullback. We weren't at the close yesterday, but now we are. We'll have to see what happens here. But if we're below 10%, I think you start to put money to work. And if we're below 15%, which would be around 4,100, which wouldn't surprise me, I think you put more money to work. I don't think we're going to have a bigger correction than that because that usually, treasuries, there's not been a big flight to quality. Equal weighted S&P has outperformed cap weighted. Financial conditions aren't wavering that much. So I think we're in a range where, you've got to be clinical. And you have to say, here we go. Here's the pullback I've been waiting for. I think you invest into.
Andrew, talk to us a little bit about the regional piece of that equation. In this kind of market sell-off that you've seen really since the start of the year, a lot of money has been put to work in emerging markets especially. You've seen EM equities actually outperform or perhaps perform not as badly as developed markets. And now you just had Anne-Marie Horder say, well, European markets are bouncing back in a way that American markets aren't. Talk to us a little bit about the regional divergence in where you would invest.
Sure. So my view, pivoting to the S&P, while I liked EM at the beginning of the year, my view was that this was going to be a kind of a very moderate year for equities versus where we started the year. 5,000 was, or 5,100 would have been, kind of single digit. It wasn't that attractive. And therefore, as you think about other parts of the world, like emerging markets that did not do well last year, they look pretty attractive. And that's because the dollar really took the wind out of the sails for emerging markets last year. Having said that, with the S&P now down to the low 4,000s, the risk return dynamic for our market here becomes more attractive. And so I wouldn't necessarily run out and sell U.S. equities here to buy emerging markets, given the magnitude of the relative underperformance of the U.S. market year to date versus EM. So to me, to sell U.S. equities and buy EM here would be selling into weakness and buying into strength, which I'm not sure is a very smart thing to do right here.
Andrew, as a counterpoint to that argument, credit is behaving at the moment, and we're not seeing the same sort of jitters in that world that we are in the equity world. Do you think that will allow the Fed to be more aggressive in its targeting of inflation? And ultimately, do you think that leads to a growth scare at some point?
I think you're right. I think that's the Fed looks at the credit markets more than the equity markets. So if the bulls are expecting the Fed chair to back off because of the decline in the market, I'm not so sure that is going to happen. But, the offset to that is as much as the big, ugly earnings reports get the headlines. So far, it's been we're very early into earnings season, but most companies are actually beating estimates. I know that's hard to believe, but that's the stat. So I still think the fundamental backdrop for corporate earnings is pretty good, and that's going to be the offset. It's a push-pull year. Yes, the Fed is pivoting, and that is what happens typically in the third year coming out of a recession. But you have strong corporate earnings, and we're just getting going in that process. So I think you're right to the extent that I wouldn't expect a major pivot from the Fed just because the market's down 10%.
Andrew, I think we've gone 10 minutes here without once mentioning big tech in an equity conversation. That must be a Bloomberg TV record. Let me ask you, though, how do you actually look at tech right now as kind of an inflation hedge, as the heaviest weight of the stock market? Is this still an environment where you can actively look at the earnings of those big tech companies? IBM, for example, reporting some pretty stellar numbers overnight. Can you look at some of those tech companies and say this is still a good bid, not necessarily on reasons for a haven, but perhaps on their fundamentals?
Yeah, look, you've had a very substantial sell-off in the NASDAQ, but I think many of these very large cap tech stocks, they're flush with cash. They're not that expensive relative to where they were in previous NASDAQ sell-offs. And I think the setup is pretty good going into earnings report. Again, I go back to I'm always very nervous going into earnings season when stocks are red hot and expectations are high because it's tough to meet. Likewise, I get more optimistic going into earnings season when stocks are weak. And that's the setup right now. So I think these large cap tech stocks, to me, look relatively attractive. Now, for our strategies, our U.S. strategies, our biggest overweights are financial and energy, but I was nervous going into the earnings reports for the banks because those stocks were too hot. And I'm nervous about some of these energy stocks because they've done very well. But the setup for tech is very attractive right here.
What would you avoid right now? You just kind of talked about the valuations around the banks. You talked around them about what is happening with energy. What else do you avoid in this market? What do you make of the consumer? What is happening in that space? Where do the risks lie in this market right now from a sectoral point of view? It may not affect the index level, but are we going to continue to see this churn? And if so, where are we churning from and to?
Yeah, I think that the risk is that the economy slows more quickly than what has seemingly worked just recently, which are, again, these banks, commodity, cyclical value stocks. And if we get a slowdown, I think some of these growth stocks that have been hurt could rebound. So to me, the risk is slowing in the economy faster than what's expected. The other issue I see is think about the CPI, PPI numbers. And I'm no economist, I'm just an equity manager, but they're measured on year-over-year monthly numbers, right? And so last year in January, February, March, we had low numbers. So the inflation prints from now until the spring are going to look ugly because the hurdle is very low. And so I think that's going to cause the Fed to say, well, we'll have to wait and see. We'll have to wait and see. So it's only into the spring that we're going to really find out, because that's when in April timeframe, that's when inflation really started to come down. Should come down because the numbers last year were very high. So the risk is that we're really not going to know about inflation till later this spring, and so we're in this vacuum period right now, and that's going to create a lot of volatility, and that's why I'm not so sure. Down 10%, the market's bottomed here.